Hi, this is a review of Applied Investments, the first four class preparation assignments. This review is intended for your use following the first exam and before we get into the other content. First, let's examine basically the concept of an asset class. What is it? Basically, asset classes are defined by their characteristics. Their risk might be different, their returns might be different, their tax consequences might be different, their location might be different. For example, U.S. stocks versus foreign stocks, developed market stocks versus emerging market stocks, and the like. The main asset classes are fixed income investments, also called debt, or bonds, but it could include things like CDs, equities, which is basically stocks, also stock mutual funds, which basically contain a lot of stocks in them, real estate, and then we have alternative investment asset classes, including commodities, hedge funds, real estate that we will study as we get into the course. Cash is often considered another asset class as well. Stocks and bonds, just as a reminder, are conduits for how corporations raise capital. Basically, they can borrow money from investors and pay interest, or they can seek capital contributions in the form of equity, basically owning common stock in the company, and in that way, uh, investors can participate in the growth of the company, but they take on more risk. Stocks are more riskier than bonds. Why? In the event of a bankruptcy, stockholders typically get nothing, and bondholders typically get a recovery rate somewhere between 30 and 50% on average, but the actual amount can vary tremendously across industries and even the time, the year that a default might happen. Capital markets have rewarded long-term investors pretty well. Here's a chart showing the returns of different asset classes from 1926 to 2019. And we can contrast that with inflation. If you started with $1 in 1926 and you wanted to spend that, if you wanted to spend the same dollar at the end of 2019, you need $14 to have the same purchasing power. And what we want to do in terms of investing is outperform inflation, hopefully by a significant margin. Unfortunately, Treasury bills, 30-day U.S. Treasury bills, don't really outperform that, especially after paying taxes on the interest. The same even for long-term government bonds. But large company stocks significantly outperform inflation over the long term, and small cap stocks do as well. Diversification, yes, it reduces risk. So you don't want to concentrate your portfolio by just owning a few stocks or a few different other types of securities. You want to diversify the way the risk of holding that. Imagine holding in your portfolio 25% of Tesla stock. And what happens if Tesla stock goes way down? Well, your portfolio is taking a big hit, even though the market might be fine overall. So you can diversify the risk of a specific company by owning hundreds of different securities. All right? And this is an interesting slide. You often see this slide used by financial advisors. Basically, it's used to basically say don't get out of the market or and the like, because uh, if you exclude the top 10% of performers each year, your return compound net average annual return is going to be less. If you exclude the top 25% of performers each year, your return is going to be a lot less than that. So basically diversify. A well-diversified portfolio, if you were to look at just one single security, security A, B, or C, you'll see ups and downs, but if you combine them, basically it becomes a smoother ride in essence, and that's something we want to achieve in the world of investing. We also don't need to guess. Here's different indexes. S&P 500 index is an index of U.S. large company stocks. The best index in my view for that. The Russell 2000 index is the long-standing index for small company stocks. Not necessarily the best index if you're looking for an index fund. Then you have a REIT index. We'll be studying real estate investment trust, international small cap stocks, emerging markets index, and then some bond indexes, short-term U.S. Treasury notes, and short-term bonds and also world government bonds. And as you can see in this chart, what asset class, if we look at these indexes and consider them as asset classes, which asset class outperforms very significantly from year to year? Just look in the black box, for example, the REITs. All right, 2005, 13.8%. 2006, they were at the top, but the next year they were at the very bottom in terms of their returns to investors. And if you take the Russell 2000 index at light blue, for example, here 4.6, 18.4, negative here. 2008 was, of course, a very bad year. Bonds did really well that year, and then they bounced back a little bit. Remember, of course, that negatives are much more impactful than positives. As I'm recording this, the market is down from its highs 33% this here in early 2020. It's March 18th or so, I believe. And the result of that is, in order for the market to get back to where it was, it basically has to gain 50% just to get back. So negative returns are much more impactful on a portfolio than positive returns. The beauty of diversification is it's as close as you can get to a free lunch in investing. One of my quotes, one of the things I often say is diversification is a free lunch. And we also want to diversify internationally, because we're not just talking about stocks based in the United States. Right? Those stocks constitute about half of the global market capitalization of all publicly traded stocks. Developed markets is still a very significant part of that. And emerging markets is increasingly a big part of that. This is a chart that just shows the difference going all the way through 2019, and you can see emerging markets at the top. The growth of that over time, it now constitutes about 10 to 12% of a world market cap. There's a lot of opportunity in equities. We do need to diversify all around the globe. This is a chart that shows different developed markets, including the United States, Western Europe, and then the emerging markets. China, even though it has a very big economy, but the amount of publicly traded stocks in China is not huge. It's significant, but it's not huge. China, India is regarded as a emerging markets, at least by dimensional funds, which put together this slide. And the reason for that is it's still transitioning away from agricultural-based and commodity exporting countries to a more modern securities market where there's extremely good regulation of accounting systems, of securities laws and regulations. And for some emerging markets, there might be political strife, unease of that. Brazil is a good example of that. Others might be threatened by other countries, South Korea, for example, and Taiwan. Although they seem to have very modern economies in many respects, because of the threat of them, they might be considered, at least by some indexes, as emerging markets. We also have frontier markets, basically other countries that just don't fit into those other categories, a lot more risky in terms of investing in them. We want to diversify away risk. How many securities, how many stocks does it take to diversify away risk? Well, if you're looking at it from the standard of standard deviation, you can get to a very low standard deviation. You can get to the standard deviation of close to the S&P 500 index by having 30 or 40 stocks. But if you do that, if you concentrate your portfolio on 30 or 40 stocks, you're likely to be you're going to miss a lot of those big upsides. Most of the returns of the S&P 500 index, or for any index for that matter, are done by just really a handful of stocks or a very minority percentage of the stocks. Typically about 70% of all the stocks in an index will underperform that index over the course of a year. So you really need to diversify among hundreds, if not thousands, of different stocks and securities. What's my favorite word in investing? Diversification. You should know that and have it, of course, ingrained in you by this time in the course. Modern portfolio theory. All right, we're going to search for that efficient frontier. Modern portfolio theory has been with us since the 1950s. All right, you'll see sometimes articles saying modern portfolio theory is dead, but the concepts of modern portfolio theory are still valid. Uh, Basically, if we take different securities and we combine them in different percentages, we're going to end up with a whole bunch of dots. Those dots are going to be represented under this line. That line is what we call the efficient frontier, and we want to be on that line. We want to have, for a certain amount of risk, which is on the bottom, the horizontal line is standard deviation. For whatever type of risk is measured by standard deviation, we'd like to have as high as expected return. Likewise, if we want a specific expected return, we want to be to the left as much as possible in order to reduce our standard deviation. So the theory is that we want to be towards the northwest quadrant, the upper left of this chart. And that is where the efficient frontier lies. So, where do we want to be on the efficient frontier? Well, it all depends on risk tolerance. We've studied risk tolerance. We've learned that risk tolerance questionnaires aren't perfect. They certainly don't take into account really too much risk need. They're affected by education, by recency. My guess here in March of 2020, after the market has gone down about 33%, my clients are a lot less risk adverse than they were in January when the market was at its peak, just because of how they're feeling, their emotions at this point. There's some other problems with risk tolerance questionnaires. A lot of them don't ask enough questions. They don't ask very good questions. Risk tolerance questionnaires software has gotten better, however, and to me it's useful to really, after you educate a client, to really look at them and try to discern where they are, where their perspective on risk is. Knowing that if you have a client who needs to take on a lot of risk, but their risk tolerance as measured by a pretty good risk tolerance questionnaire is low, then you know you're going to need to educate them, continue to educate them pretty well before any market event happens.